I talk a lot about the difference between bonds and bond funds, and it's because they're not as obvious as they may seem. So here we go. Let's start with individual bonds, because those are the components that actually make up a bond fund. With an individual bond, you basically made a loan to an issuer, to a company, to a state, a municipality, to a federal government, or some agency. And in exchange for that loan, you have two important guarantees. You have a contract that says you get a guaranteed interest payment on a regular basis until the loan's repaid. Typically, that's semi-annually. And the second guarantee is that when that bond matures, you're guaranteed to get back the full face value. Okay? And of course, those guarantees assume that there's no default or no bankruptcy, if you will. In the middle, however, while you're holding that bond, the market value of that bond can go up and down with market forces. So if you hold the bond to maturity, you have those two important guarantees. If you need to sell the bond before maturity, then you're gonna get for it whatever the market will bring. So where do bond mutual funds come in? Well, bond mutual funds are pools of investors' money to buy diversified portfolios of bonds. So in some ways, that means that bond funds can be construed as being safer because they're more diversified than if you own one, two, or maybe three individual bonds. However, when you buy a bond mutual fund, you lose those two guarantees that are the guarantees that attract people to individual bonds. Why? Because in a bond mutual fund, the interest payment can and does fluctuate. And also, there's no guaranteed maturity date for the fund where you're guaranteed to get back all your money. Which means now that in that way, you're taking more risk. In fact, if you were to study for your license to become an investment advisor, you'd learn that the definition of a bond fund, according to the regulatory authorities, is as follows. It's the stock of a company that owns bonds. So it even sounds riskier. So when do each fit in? Well, as a general rule, and this isn't a recommendation for you because I don't know you specifically, but as a general rule, if you're a small investor and or you don't know anything about buying individual bonds, then bond funds might be the better answer because you can have professional management and cost-effective diversification. However, if you've got $250,000 or over and you're an astute investor or you have a professional, an income specialist who can help you with it, then having a diversified portfolio of individual bonds can allow you, and bond-like instruments can allow you to have your cake and eat it too. Why? Because now you have enough money to cost-effectively diversify and also have that fixed rate of income for the life of each individual bond and also that fixed repayment of the face value at some point in the future at maturity. And again, both those assume, once again, that there are no defaults.